Hi class, well now that you've gotten through chapter 1 and learned some of the definitions and some of the concepts, and that's the most important, is learning this new language. But I'm going to try and go over debits and credits and how I teach it in a face-to-face class, which is using the accounting equation. So our accounting equation is assets equals liabilities plus stockholders' equity. And what I like to do are T accounts. So a T account is just an account that is in the form of a T, and the left-hand side of the T account is a debit, and we abbreviate that as DR. And the right-hand side of the T account is credit, and we abbreviate that as CR. And I'm going to have a T account for every single account that I have. So I have a T account for cash, one for accounts receivable, one for prepaid insurance, and another one for equipment. These are all examples of assets, and assets are listed in order of liquidity. That means how fast we can convert them into cash. So I'm going to go to the other side. Well, let's stay on this side first of all. So how do debits and credits behave on the asset side? Well, a debit does not mean it makes it go up or down. It all depends on the account that you're talking about. So with debits, it's plus minus. Okay, a debit makes it go up and a credit makes it go down. Okay, so you got to learn the rules of debits and credits and pretty quickly. If you do, it's going to make this course so much easier because the rest of the course is debits and credits. If you don't learn them, I'm going to lose you by chapter 3. So now let's go to liabilities, and we're going to have here, let's put accounts payable, and we'll abbreviate that as AP. Again, this side is the debit, this side is the credit. And let's put another one here. Let's put notes payable. Notes payable. What's a notes payable? It is a loan. You borrowed money from a bank. It's usually called a loan, but the real term is notes payable, since you have to sign a promissory note. So this side is a debit and a credit. We can usually tell when it's a liability because they usually end with the word payable, which means we need to pay it back. Now, payables are not expenses. Expenses can generate payables, but expenses can also generate assets. So a lot of students get confused that liabilities are expenses. And then let's put another one, an odd one here that doesn't end with the word payable. We'll call this unearned revenue. And that's coming up in this chapter, in chapter 3. It's going to be very important. Unearned revenue. So again, this side is a debit and this side is a credit. So now, how do these behave? Well, they're on the other side of the equation. And since they're on the other side of the equation, in order to keep it balanced, they have to behave the opposite. So a debit makes it go down, a credit makes it go up. A debit makes it go down, a credit makes it go up. So that's how liabilities behave. So now, here we put stockholders' equity. Now, stockholders' equity is comprised of a lot of things. It's comprised of common stock. It's comprised of retained earnings, dividends, revenues, and expenses. All of that is part of stockholders' equity. So I'm going to put here common stock. Common stock, and this side is again a debit, this side is a credit. Then I'm going to put here retained earnings. And we're really not going to deal with retained earnings right now, but we'll put it in here, debit, credit, and then let's put our revenue. Let's put our revenue, and let's put fees earned. That's usually what we call our revenue in a service business, or we can call it service revenue. Or if I'm an accounting, I could call it accounting fees earned, or if I'm a doctor, I could call it health fees earned, so forth and so forth. Now, I put these three together for a reason. And then I'm going to draw sort of an imaginary, well, if you can see it, it's not imaginary, but an imaginary dotted line, and because these make equity go up. So if they make equity go up, they're going to behave the same as liabilities. A debit makes it go down, and a credit makes it go up. Okay. But then there's two types of accounts that make equity go down, and that's dividends and expenses. So that's why I'm putting this dotted line, like an imaginary dotted line, and I'm going to put dividends here. Dividends, this is a debit, this is a credit. And then I'm going to put some expenses here. And expenses, we're going to have a whole bunch. So we're going to have here wages expense. And I like abbreviating expenses with XP. And then let's put rent expense. Rent expense. And then let's put here insurance expense. And you can see right away I run out of room. Insurance expense. So these are my expenses. So these make equity go down. That's why I listed them separately and separated by that imaginary dotted line. So since they make equity go down, they have to behave the opposite. So a debit makes it go down and a credit makes it go up. I'm sorry, a debit makes it go up, credit makes it go down. So it's plus minus, plus minus, debit makes it go up, and a credit makes it go down. So that's how I teach learning debits and credits. Now let's do some transactions. Let's say that I am going to buy 1 year's worth of insurance for cash. And let's say that 1 year's worth of insurance is let's make it easy, $12,000. So I go to my insurance agent and I'm going to give him or her a check for $12,000 for 1 year's worth of insurance. So if I'm paying for it, what's going out? Cash. So I'm going to credit cash. And what am I getting? I'm getting an asset called prepaid insurance. It's not an expense, because an expense is something that I've used up. So as I use this up, it'll become an expense. But right now it's an asset. It stays on one side of the equation, and all I'm doing is exchanging one asset for another. That's it. And my debits have to equal my credits. So let's say that I went out and bought $10,000 worth of equipment with cash. Okay, so what am I getting? I'm going to increase equipment and I'm going to decrease cash. So I'm going to debit equipment and I'm going to credit cash. Again, I'm exchanging one asset for another. Equipment is not an expense, not until we use it up. Keep that in mind. An expense is something that I have used up. Why do I use up expenses? To generate revenues, which is what we're in business for, to generate sales, to generate fees. So now let's take a look at liabilities. Let's say I went out and I applied for a loan and I got a $20,000 loan from the bank. So I'm getting into debt. I got a loan. So my liability is going up, which we call notes payable. But what am I getting? I'm getting cash. So I'm going to debit cash for $20,000. So now it affects both sides of the equation. So I'm getting a loan, and if I'm getting that loan, I'm getting cash. So let's say I bought equipment, $2,000 of equipment. So what am I going to do to equipment? $2,000, I'm getting equipment. But let's say I bought it on credit. That means I'm not going to pay it till later. So that's an accounts payable. So you see, this liability did not create an expense, it created an asset. So I got this equipment by financing it. All right? Now, let's talk about unearned revenue. What is that? The unearned revenue happens all the time. That's when you pay for something in advance, or when a client gives me money in advance and I have still not performed the service. So let's say that a client pays me $5,000 to do something that I will be doing in the future. I cannot recognize it as revenue because I have not provided the service. So therefore, I'm going to credit $5,000 and debit cash for $5,000. It's not revenue, it's unearned. It only becomes earned when I do the work. So let's say, for example, you get in trouble this weekend, which I hope you don't. But let's say you get in trouble this weekend and you end up in jail. Now, you're probably going to need an attorney. So you're going to call the attorney, and the attorney is going to review your case, and he or she is going to say, I'll take your case, but I need $5,000 right now. Has that attorney done anything for you? No. So he or she owes you $5,000 worth of services. And as they provide you that service, it goes from unearned to earned. That's what's going to happen in chapter 3. And if you understand that, as I use this insurance, it'll become insurance expense. If you understand that, That's chapter 3 already, which we call adjusting entries. So let me explain some stuff of unearned revenue. Gift cards. If I go to Target and purchase a $50 gift card, Target is going to debit cash for $50, and it's going to credit unearned gift card revenue for $50. When does Target recognize that gift card as revenue? When they use it. When whoever you gave it to uses it. The same thing when I buy a concert ticket. If I buy a concert ticket today, the promoter cannot recognize it as unearned. It cannot recognize it as revenue until you go to the concert. That's why right now when a lot of concerts are canceled, they have to give you the money back. They owe you that money back. Airline tickets, the same thing. If I book a flight today on Southwest cannot record that as revenue. Not until I get on the flight and fly. Or let's say I buy a gym membership for a year. The gym cannot recognize that as revenue. Because, so let's say I pay $120 for a gym membership revenue for a year, which would be $10 each month. So therefore, what's going to happen? As each month goes by, it's going to go from unearned to earned. Unearned to earned. But why they not record it as revenue? Because they owe me 12 months worth of gym membership. And in some cases, if I cancel it, they owe me the money back. That's why they're considered liabilities. So let's take a look. The owner invests $10,000 in the business. So when the owner invests, we give them common stock. So we're going to credit common stock for $10,000, and the owner is going to give the business $10,000. That's how it would happen. So let's say we performed the service for $2,000 cash. So therefore, I'm going to credit $2,000 here for revenue, and I'm going to debit cash for $2,000. Notice I did the T account for cash long because that's where most of your transactions are going to be flowing in and out of. Now, I could also do a service and not get paid. So let's say I did $3,000 worth of service, but the client is not going to pay me until a month later. So do I recognize that a revenue? Yes, it's revenue. But now they owe you the money, and that's what we call accounts receivable. So what are accounts receivable? It's stuff that I've sold on credit, whether it's goods or services. Now, we're not talking about a credit card. A credit card, for example, Visa, MasterCard, Discover, American Express, that's like cash. But we have our own private accounts, and we've made arrangements with a customer that they have a credit line with us, and as they buy from us, we have revenue, but they owe us the money. Now, let's say that client paid me back $1,000 that they owe me. So what am I going to do to accounts receivable? Credit it for $1,000, and it's going to come into cash, but it's no longer revenue. Revenue is recognized at the moment you do the work, or at the moment that you deliver the goods. So let's take a look at expenses. Well, let's say I paid $1,000 for rent. So what am I going to do? Debit $1,000 for wages expense and credit $1,000 in cash. Expenses will always go up. Or I'm sorry, that I said rent and I put it under wages. So let's say it's both wages and rent. So we'll put another $1,000 here. Okay? So expenses will always go up. Now, let's say I pay back some of this loan. Let's say I pay $1,000 back. So what am I going to do? I'm going to debit that for $1,000. And how do I pay it back? With cash. There it is. So this is where that would go. So now out of this notes payable, I no longer owe $20,000. I now owe $19,000. So let's say I pay off this liability. So if I pay it off, what am I going to pay it off with? Cash. Okay, and so I need to make this go down. So now I owe them how much? 0. If you notice, that's where it went. So I debited that and credited this. And now I owe them nothing. So let's say I did now, a month has gone by and I did $2,000 worth of work of this unearned. So what am I going to do? Debit this for $2,000, and if it's now, it goes from where? Unearned to earned. So I'm going to credit this for $2,000. And now how much more work do I owe them? $3,000. So this is the whole basis of the course, our debits and credits. Let's do one more. Let's say that out of this $12,000, remember, this was for how much? 12 months. So if I'm using up each month, it's $1,000 a month. So let's say that I've used 1 month worth of insurance. So what am I going to do? I no longer have it because it's been used. It's been used. So now I only own $11,000 worth of insurance. And if it's been used, what does it become? An expense. And that's chapter 3, guys. This prepaid and this unearned, that's chapter 3. So the main thing is to learn these debits and credits. And that will make this course so much easier because this is not going to go away. Thanks.